Hello guys, and welcome back to another exciting video from Crypto Channel. Today in this video, we bring you major updates and news on Olympus DAO, home updates, and much more. Make sure to stay with us until the end. Also, next to that, we have some exciting news to share today. We're doing a giveaway for each video from now on. To win 15 OHM tokens, you have to follow 3 easy steps. 1. Like this video. 2. Subscribe to our channel. And make sure to stay with us until the end of the video as we announce the winner. So let's begin. The current state of DeFi is one of deep irony. Despite being conceived out of the desire to de-dollarize, DeFi is exceptionally dependent on dollar-pegged stablecoins, with $97 billion of USDT, USDC, and DAI in circulation. While these assets are more stable than Bitcoin or Ether, they reintroduce the dependencies and risks of the fiat system we are attempting to leave, such as inflation and centralized, unaccountable monetary policy. One project that's attempting to tackle this issue is Olympus DAO. Launched in March 2021, the protocol is aiming to design a non-USD pegged stable asset. It's a project you might have known about, as it boasts madly high APYs and profiles with 3 are all over Twitter. It additionally may appear to be somewhat strange concerning why the price of a stablecoin like OHM has been everything except. So what's the deal? How does Olympus work? Are the yields sustainable? That is the thing that this video will explain and highlight why Olympus is quickly arising as one of the DeFi's most fascinating protocols. Olympus is a protocol that is answerable for the issuance and management of a completely backed, algorithmic, free-floating stable asset, OHM. That definition is a significant piece, so how about we separate it piece by piece? OHM is completely collateralized, as it's backed by a treasury of crypto assets that sit under the purview of the Olympus DAO, which is known as the Protocol Controlled Value or PCV. The DAO has decided that each OHM issued must be backed by $1 in collateral. However, this can be changed by a governance vote. At first, this consisted of only DAI, which each OHM issued having 1 DAI in the treasury as its backing. Nevertheless, the protocol has since expanded the treasury to include different assets such as Frax, another algorithmic stablecoin just as OHM DAI LP tokens from SushiSwap, and OHM Frax LP tokens from Uniswap. There are likewise active governance proposals to add ETH and BTC to the treasury. This implies that now each OHM is presently 2 times backed from a combination of these assets instead of solely DAI. As should be obvious, the current value of the assets in the treasury sits at more than $70 million, with its composition sitting at generally 71.8% DAI, 27.8% Frax, and 0.4% Sushi, the governance token of SushiSwap accumulated from yield farming rewards. While Olympus has been compared to a private bank issuing its own notes, another fascinating parallel that comes to mind is the Federal Reserve. As we probably are aware, in the fiat system, the Fed holds a wide range of assets such as the US Treasury bonds, gold, dollars, and foreign currencies, which they use to assist with conducting monetary policy. Olympus deals with a comparable balance sheet, but the currency which it administers and issues is completely backed by these assets, while of course the USD dollar isn't. While Olympus permits the market to a great extent determine the price of OHM, it uses the assets in the treasury to assist with keeping the price as close to $1 as could be expected. At the point when OHM trades at a premium as it does now, the protocol will mint OHM and sell it out from the shadows market to increase supply and drive down price. The DAO will likewise mediate should OHM trade at a discount, as though its value falls underneath $1. The protocol will buy back and copy tokens to decrease the supply and increase price. Despite the fact that Olympus conducts open market operations, the price of OHM is largely permitted to float. This implies that instead of having its price pegged to that of another asset, such as USD, the value of OHM is determined by the free market. Because of this, its price in dollar terms can and has been volatile, as like some other non-pegged assets, it's subject to the impulses of supply and demand. Despite this, OHM is considered to have a floor price or risk-free value or RFV that merits the measure of asset backing each token. The current RFV of the protocol treasury is comparable to the stablecoins, and to account for risk, a discounted value of the LP tokens in it. This implies that currently, OHM is exchanging at a premium to its RFV. This might be because of a few unique factors, such as demand to stake OHM, or potentially the future expectation of earnings disseminated to OHM holders from the treasury assets being deployed inside DeFi. What's more, because issuing new OHM just requires $1 worth of collateral, the premium likewise addresses the measure of OHM that can be minted later on. For instance, in light of the RVF and circulating supply metrics listed over, the protocol can increase the current supply of ohm by 21 times. Of course, this is subject to change, yet implies that as the value of the treasury develops, the capacity to issue more ohm will see a commensurate increase. Since we understand the characteristics of ohm, we should jump into how it enacts its monetary policy. Since the protocol is in its infancy, Olympus DAO current objective is to develop the supply of ohm. While it's intended to ultimately have a stable value and may appear to be counterintuitive, the protocol isn't promptly aiming to achieve this. This implies that unpredictability can and ought to be expected. Of course, it ought to likewise be noted that we presently can't seem to check whether the protocol can effectively stabilize the price of ohm. There are two key mechanisms utilized by the protocol to carry out its monetary policy objectives: staking and bonding. Well, before we get further into the video, let us know your views whether Olympus is a good investment or not in the comment section. Staking. Staking is the process through which the protocol issues new ohm. There are a couple of reasons why ohm holders would need to stake their tokens. For starters, as with different systems, it can permit them to lock in their share of the total token supply and try not to face dilution. Furthermore, the high ohm denominated returns can assist with offsetting the price risk that comes with the instability of the token. Currently, more than 93% of the ohm supply is staked. Like some other assets, ohm can be purchased on a decentralized exchange, such as Uniswap or SushiSwap, and once staked, holders will receive the new distributions as S-ohm, just as 90% of the yield produced by the assets in the treasury. Ohm rewards are paid out like clockwork, with stakers' S-ohm balance rebasing to account for the new tokens. This likewise implies that rewards are compounded 3 times each day, which can assist with explaining why Olympus has such significant returns. Olympus can sustain these yields because of the premium that we discussed before. Since each ohm just necessitates $1 in backing, and each token in circulation currently has more than that in backing, the protocol can utilize these excess assets to issue more tokens. It likewise implies that as the value of the treasury develops, so does the capacity to mint ohm and continue to pay out exceptional returns to stakers. Bonding. Bonding is the process of selling an asset to Olympus in exchange for discounted ohm. That vests throughout the span of 5 days. Clients have an incentive to bond when the return they would earn from it is more prominent than that from staking. While the protocol at first just offered bonds for ohm DAI and ohm Frax LP tokens, this has been extended to include unadulterated stablecoin ones. Bonding serves a few key functions for Olympus. For starters, it fills in as a funnel for the protocol to have the option to accumulate more assets and develop its treasury. In doing so, it can develop its RFB, in this way having the option to increase the measure of ohm that can be issued, just as sustain the significant returns for stakers. Past assisting with development, bonding assumes a key part in that it additionally serves to indefinitely secure the liquidity of ohm. As we probably are aware, capital in DeFi is mercenary, constantly moving in search of the best return. As a result, numerous protocols have a toxic relationship with their liquidity providers and are regularly forced to pay them to stick around with token incentives, decapitalizing themselves in the process. Through LP bonding, Olympus can turn this dynamic on its head. That is because it empowers the protocol to claim and control its own liquidity, with LP tokens held by Olympus known as Protocol-Owned Liquidity or POL. This implies that instead of incentivizing or hoping third-party providers continue to provide liquidity, the protocol can, to quote Thanos, do it without anyone's help. It additionally implies that should the DAO continue to hold the LP tokens, there will be a constant and developing floor of liquidity that's accessible in interminability. Bonding has so far been an effective mechanism for executing this procedure, as the protocol currently possesses 98.5% of the liquidity for the Uniswap V2 Ohm Frax pair and 99.5% for the Ohm DAI pair on SushiSwap. One more intriguing characteristic of Olympus that might contribute to the energy of the Ohmies is that it's represented directly by Ohm holders. This separates it from other stablecoin protocols such as DAI, FEI, and RAI, and of course, centralized stablecoins like USDC or USDT, whose monetary policy is determined by holders of a secondary governance token or C-suite management respectively. This implies that the holders of the actual currency, instead of proprietors of a secondary governance token, are the ones who determine monetary policy. This is a compelling dynamic, as it encourages active participation from a wider set of stakeholders. What's more, it adjusts incentives of all participants in the system and encourages monetary policy decision-making to be made from the perspective of what is best for the value and stability of ohm. Finally, it likewise limits the risk that governance token holders make changes to the protocol that might assist a crew with valuing the governance token to the detriment of the currency under the purview. Olympus DAO is a fascinating project. The protocol is endeavoring to tackle a tremendously driven issue through its special design and incentive mechanisms. It's likewise figured out how to be immensely successful at attracting quick development and a crazy community. While it's unclear on the off chance that it'll at last succeed in achieving its vision, plainly Olympus is a project worth watching out for. So that was all for today's video, guys. Do like this video. Also subscribe and share to our crypto channel. This week's giveaway will be 15 OHM tokens. To make sure you have a chance of winning, you need to like this video and subscribe to our channel. So stay tuned and let us know your thoughts on Olympus DAO in the comment section.